Hey there, and welcome to Real Investment News. I'm Mike O'Neill. The markets seem to be getting back on their feet today. The Dow is up 280 points, the S&P is up 25, the Nasdaq is up 80. Now, last week's big drops are serving as a warning shot for passive investing. That's according to Lance Roberts, the chief strategist for Real Investment Advice. In his blog post this morning, he talks about the dangers of what happens when passive indexers turn into panic sellers. Now, we warned about this last month. That was when we told you how there are actually just 4,300 publicly traded companies in the U.S. That's higher than in the past couple of years, but well below where we were back in 1980. But the number of exchange-traded funds, those ETFs, globally is much higher. We have more than 5,000, and a lot of these ETFs are holding on to some of the same big companies like McDonald's, Apple, and Walmart. So when we get sell-offs like we did last week, the drop is bigger than it should be because too much capital is concentrated in too few places. Now, have we seen this before? You bet we have. Back in the 1970s, we had the Nifty 50 stocks crash, the portfolio insurance crash in the 80s, the dot-com crisis in the early 2000s, and of course our most recent real estate crisis in 2009. Now, a lot of investors are relying on these so-called robo-advisors to help manage their investments, and they don't have the stomach to deal with minor corrections. So when the S&P dropped last week, we saw a rush of people trying to sell, so much so that two of the country's biggest robo-advisor websites, Wealthfront Inc. and Betterment LLC, actually crashed as people tried to log onto their accounts. Lance compares this to a crowded theater, like when someone yells fire, there's a rush to the exit, but a lot of these investors are going to be stuck in the back. They're going to have to ride it out. Thankfully, this wasn't a crash, despite those headlines. There were a lot of reports saying that this was the worst decline since 2008. So which decline is it? This is the S&P from 2000 through 2009. Are we talking about the summer of 2007 when the market corrected 10%? Well, people just bought into that dip. Was it at the end of the year when we had a 12.9% drop? Well, that was when the S&P fell below the 50-week moving average, which is usually a good sign to start selling. There was even one more drop, a 13% fall in the spring. All of those came before the bottom fell out with the Lehman Brothers bankruptcy in September of 2008. Investors lost 29% of their capital in just 3 weeks. So what are we saying? Well, we can't predict the future, but we can see how warning signs were ignored in the past, and knowing how quickly the boulder can roll downhill once it starts, well, what is your plan for when the real correction actually begins? Now, you can read more about Lance's thoughts on passive investing and exit strategies at realinvestmentadvice.com. Also, remember to follow us on Facebook and Twitter and YouTube. Check out our past reports at realinvestmentnews.com. I'm Mike O'Neill, and we'll see you again in a couple of hours.